I'm Danny from Data Science Society, and for those of you who don't know about Data Science Society, this is a volunteer organization with the main goal of promoting the domain of data science and machine learning. And today, for the meetup, we want to thank our hosts from Limpum, who are dealing with lots of customers' data for delivering marketing, mobile marketing solutions. We want also to thank our partners from Telelink and OntoText, who are leader in their field in NLP and also delivering on-cloud solutions and digital solutions. All of these companies are dealing with lots of data, petabytes of data daily, on a daily basis. That's why we are partnering with them. And for today meetup, we have the interesting topic of data science in finance. And I want to introduce you to Metodi Nikolov and also Georgi Kirov, who are our special guests today. And also, to let you know that during their presentations, we will start first with Metodi, after that with Georgi, but after each presentation, you will have the opportunity to ask questions. During their presentations, you can go to Slido using the hashtag DSS. Don't forget to do that. And after the two presentations, there will be network and networking, yes. Yeah, not switching, yeah. Networking, but you can also now grab a beer, water, and enjoy the meetup.
Okay, before we really start, I would like, my name is Angel from Data Science Society. I would like to give a heads up before everything starts today. I would like to give you a heads up about our next thing. Actually, we're going to have two coming things in the coming several weeks. First of all, we are moving towards a much more open organization than we are currently. We are going towards initialization of non-government organization officially and so on. We are changing a little bit. So on the 23rd of October, which is 2 weeks from now, in the same place, we are going to have an initial meeting of this, starting meeting of this organization. It's going to be Data Science Society again, but it's going to be legalized. Everyone, if you wish, if you think you can help us by volunteering or any other way, you're welcome to come. And this means that I will have to give our pillars. Actually, they're here. One of our pillars is training and workshops. The other is datathons and meetups and events. And the third pillar is special interest groups. So far, we have had huge interest in all of them. So if you feel like you can contribute, you're welcome to come here on 23rd of October. And now, before the other thing that is coming, I would like to ask you, how many of you are here because of the word finance? Please raise your hands. All right? And I assume that the others are here because of the words data science. I assume correct. So for both groups, but especially for those who are looking for the connections between the two topics, the finance and data science, actually today is our launch of the first special interest group that we are starting here at Data Science Society. The special interest group on data science in finance. So our next event will be probably in the the first half of November. Let's put it that way. Will be a workshop on deep learning in finance. And as soon as we have details, we are going to invite all of you. But just have in mind that this is already a special interest groups on finance. So here we are moving towards our first guest, our first lecturer and good friend of ours, who has been a researcher in the fields of data science in finance for the last probably 15 years, yes? And some of you might already know him. He has an illustrious career so far. But both of our lecturers today want to be a little bit, keep it close, keep it shy, keep it secret. So I'm going to let them to represent themselves. Now, Metodi Nikov.
Thank you, everyone. Thank you so much, Angel. My name is Metodi. It's really an honor to kick off these special interest groups. When we discuss how this whole presentation is gonna... Can you hear me? Very strange. How it's gonna go, we kind of settled on the idea that we have kind of two types of people that usually come to our meetups. One is the finance guys. They know the models, they understand what is going on. The other people are more into statistics and the data science and know what the models are, but doesn't really have been exposed to the idea that the finance and the econometrics people assign to the model. So out of all of these came the factor models in finance, an overview topic of today's talk. Before just giving you the agenda, I want to go through the goals for today. First is, and the main objective in front of me is to show you what data science tools are used within finance and how the finance guys think about the models and use the tools. And we kind of will focus on factor models. There are a lot of different other things that we could have focused on, but just to keep it under 30 minutes, we kind of focus on factor models only. We're not going to do extensive reviews. We're not going to go into each and every model extensively and talk and discuss. I want to give you the overview, show you what is going on. We're not going to go through all the possible models that are can be classified as factor models within finance. It will be very difficult, and if you have 3 weeks, maybe we can do that. But for one evening, I think it's enough. And probably the least important on this list, but equally important in the grand scheme of things, I want to give you the key search words that you can use afterwards to expand anything I say, and if you want to dig deeper, just to know where this is, how you can search for it and deal with it. So, it works. The 4 main topics for today would be time series factor models, which would be the very simplest ones, and we're going to build out of them into cross-sectional factor models, see how the whole machinery there works, not extensively as I said. We're going to discuss other factor models, and the last point I kind of wanted to include it to discuss a little bit about the different models and methods for fitting the actual factor models and regressions and whatnot in there, because besides the actual model that there is also different kinds of estimates that one can use, and they're used sometimes differently for different aims. Sounds good? Okay. The first one, of course, time series factor model. And the simplest one, most of you guys would recognize this as a single factor linear regression, is the so-called capital asset pricing model. This is the way it can be fit. The actual model, of course, assumes takes expectations on both sides of this equation. It postulates that alpha is 0 and beta equals 1 means something for the econometrics guys. But the point of the matter is this is probably the simplest factor model that I could find, which is part of a academic article concerning linear regression. And I also wanted to use this as a segue to discuss some very important for the econometrics and finance guys terms that are used throughout and that the data scientist may not know what actually means. And for example, this part here, capital R with M, this is what the econometrics people call market return. And it's a very important thing when we discuss econometrics and finance. What is the market? What is this whole universe of things that go and define a market? Very common thing, for example, is to take a broad market index. Think about S&P 500. Think about Russell 3000, if it's US based. Think about a global equity index that spans UK, Germany, US, of course, and all the others. So this would be the market. The risk-free rate. This concept basically says, okay, these are money that are coming to me and they're certain, there is no risk, I will always get them. And what is a risk-free as an investor for you? It's not the US Treasury rate. Only the US government can issue debt and expect to take that interest rate. No one else can. So different, in different times, you actually need to do certain things to calculate what the risk-free rate is. Usually from swap markets. How many of you know what a swap market is? Okay, so it's basically a way I will give you a floating rate, you will give me a fixed rate every 6 months, and we're gonna swap this. That's why it's called swap market. We're gonna swap these interest rates for the next 5 years. And when these two parties, they deal, they calculate the fair price, and this fair price is actually the swap rate for 6 months over the next 5 years, for example. Excess return is basically market return minus the risk-free rates. This is what you're getting for your risk. This is more return than the risk-free rate. Of course, you want this to be always positive, otherwise you're taking risk without actually getting anything back. And this is actually done for both the market and the asset here. And then we come actually to the parameters of the linear regression. And alpha, usually called excess return within the econometrics, is basically the intercept of the simple linear regression model. And this is the return that the stock will get over this linear combination here. And beta, which is the slope, quite natural, of this linear regression it's a very well-known term that I don't think everyone understands what it means. People talk about beta as a measure of risk. It is not. It is a coefficient of linear dependence. This is the textbook statistic definition of beta here within the linear regression. It basically just says, okay, if the market goes up by 1%, the equity or the asset will go up by beta times 1%. And that's it. It's not a measure of risk. Usually beta equals 1, usually within the academic papers, which means that the equity moves the same way that the market moves. Alpha under capital asset pricing model is 0, which means that there is no idiosyncratic return on top of the market return. Some names. William Sharp, Jordan Lintner, Jack Trainer, Fisher Black. We're going to see this guy a lot. All of them building on top of Harry Markowitz. There is a Nobel Prize here for this work and a lot of other work in conjunction with the capital asset pricing model. So, very smart people. Now, as it turns out, it doesn't really work. It doesn't work on multiple levels, actually. The alpha is not 0, beta is seldom 1. You are not capturing the variance here in the epsilon is a bit too much. It's not Gaussian. It's very seldom IID. So on subsequent months, you might see different volatility, which doesn't allow for the fitting of this. We're going to discuss this in the later part of the presentation. But it also doesn't work because it's a single factor model. I mean, how many times in your work you get one factor, one variable, and you're able to explain with that one variable $500? Just, no, it doesn't work. And some people sit down and think, okay, then we'll add factors. We'll aim to see that we have aim to get a model with more explanatory power. It's able to explain more of the variability of a stock or an asset. And it's basically a way for me to show you a multi-factor regression. That's all there is here in this particular form of this model. It's a three-factor model which moves it from one-factor regression. So if you recall, you can write down the solutions, an estimate of single-factor model just using correlations and variance, and that's it. And it's very easy to do. Not so much here in the three-factor. You need to use some matrix algebra in order to do that. I'm sure you know this. I'm talking a bit much. But besides the three-factor model, the new thing is actually the addition of these two new models. And they have particular way of being expressed. SMB, which basically stands for small minus big. This represents the size of the company. We're talking about equities here. So this is a stock of a public company. It is traded on NASDAQ or New York Stock Exchange or any of the other, I think 15 by latest counts or even more stock exchanges throughout the US or anywhere else. So SMB basically gives, if it's a big company, then we expect the return to move in a certain way. If it's a small company, then we expect it to move a little bit differently. So the guys added something like this. And the guys are Fama and French. These are two people. Kenneth French and Eugene Fama. High minus low, or HML, this is another fundamental. By fundamental, I mean something that is inherent within the actual company. So it's not a feature of the stock that is traded. It's a feature of the actual company that has that stock. So it's two different things. You can think about the stock as something that is traded, and most of the things that you can do with it is from the market prices from the exchanges. Okay, fundamental data this is something that comes from the actual company, and a company may have different stocks which are traded on different exchanges, and they have different trade prices and different behavior on the different exchanges. Still, the fundamental data is all the same. So these two actually come from the fundamental data. And high minus low, the other way to look at it is it a growth company, so we're expecting the price to go up, or is it a value company, so the price will stay mostly the same, but the company will issue dividends regularly, and we are going to take our money not from price appreciation, but rather from the dividends that the company pays. So it's more akin to a bond that pays regularly. Funny thing is, actually, even today, you can go to the Kenneth French website and download these data. And not only for this data, but for a lot of other factors. They also have five-factor model. I think actually there are two different five-factor models that these guys made, but we're not going to discuss them. What I want to discuss actually, and it's more linked with the data part, is how these two factors are calculated. Because what they did very much is finding factors. The way that they calculate, and what the industry actually later on began to do, is a way to generate factors. And the algorithm is very simple. You take a big enough sample of stocks, Russell 3000, which are just shy of 3,000 US stocks, the largest companies. You sort them, let's say, by market capitalization. So how much stock there is times the price gives the market capitalization. You sort them by this thing. And then you form two portfolios. You take the top 10% of the stocks by market capitalization and the bottom 10%. And the top by market cap would be big, and the bottom by market capitalization will be small. That's where small and big comes from, basically. Small capitalization, large capitalization. And when you form these two portfolios and calculate the return of each these two portfolios and you subtract them, you get your factor. So this is basically an example of just data wrangling and extracting information from different equities in order to calculate that. And you can do the same for high minus low. You just do the ordering by book to price ratio. So it's the same idea. I think the data for the 5-factor Fama-French model uses something a little bit different, but it's not part of this calculation. What I want to use as a segue for later slides is actually, this is a paper from '92, so quite some time. So 30 years, give or take, which is a lot in finance and even more in data science. So it's an old paper. But the paper is called Cross-Section of Expected Stock Returns. And the key word I want to use is cross-section. And just to explain you here what cross-section means. The KPM model, when we feed it, we used historical data of the market and the stock with it. So we observe the variable through time. Here, when we define the factors, we don't take a time series, we take at one point in time the whole US market, for example, or the UK market, or doesn't matter. This procedure works with any large enough sample of stocks. So we take at a single point of time a cross-section of the market. And I'm not sure if this was what led to the next models, but I'm going to use them as if this is what led to the other models, which are cross-sectional factor models. Yeah, so far we have assumed that we observe the factors in time and we estimate their loading or their dependence or the stock's dependence on these factors in time. Now we're going to switch things a little bit. We're going to use the cross-section. So we are going to take our stocks, all 3,000 of them. We're going to take their fundamental ratios or whatever. It could be market cap as in small minus large. It could be book to price in high minus low, or it could be industry classification. What this company does. Is it a technology company? Is it oil extractor? Is it producing tubes for oil extractors? All of these are fundamental factors. And we're going to use those within the cross-section. And what we're going to estimate is what is the common return that is driving the stock's return. So we're not looking to estimate the dependence, rather we have the dependence, but what we want to see is what is driving the return through that dependence. And we are going to estimate these returns. So in a sense, we can't observe a market capitalization factor. we assume that something like this exists. We know that if there is a loading to that market capitalization factor, it must come from the market capitalization of the stock. Otherwise, it's not called that way. It would be called something else. We have other models to discuss afterwards on that idea, but the market capitalization factor should affect stock prices through the market capitalization of the stock. We don't know the return, but we can estimate it through a factor model. And this is what the whole idea of cross-sectional modeling is about. Estimating returns of unobservable factors that we can afterwards use for a lot of things. For example, we can use it for risk modeling. Okay, we can see now we have data for time. We do this each and every date. We estimate the returns and see, okay, on December 1st, the market capitalization factor had a return of 0.3%. On December 2nd, it was minus 0.1, for example, or something. Using this, we can calculate variance. We can simulate, estimate value at risk, expected loss, or other risk drivers. Or we can use it within what is usually called alpha model. And alpha model, it's not for risk. It's for basically saying, okay, this equity will have more return than this equity going forward. And this information is very useful when you do, for example, portfolio optimization. Knowing the expected return of an equity within a portfolio optimization problem is a bit more important than knowing the correlations. You get better results if you know how the stock will perform rather than just using the correlations for that. Now, the way a cross-sectional factor model is fit is usually done in steps. We, for example, have a market factor. We'll fit that first, extract the residual, then we'll fit it on the other fundamental factors. Then maybe we take residuals and do something else afterwards with them. It's all possibilities, and as data scientists, the sky's the limit on what you can actually apply. Hopefully you do something new and then you publish and you get tenure, for example. The usual medium where a cross-sectional factor model is applied is for stocks or equities, but you can do it for other things as well. You can do it for hedge fund, mutual funds, for example. Hedge funds are different beer. But yeah, most other instruments are actually there. And the funny thing is that fitting one model is usually not enough. You want to do it many times because you usually operate in different regions. You have your global model, for example, which will operate throughout the world, and you have global factors, and everything is done on global set of stocks. But then you get your regional factor model, and that model is purely for the US market. Of course, you can do it for the UK, or you can do it for Germany, or any other large market. The Japanese is also very often used. And I don't have a point here, but it's actually a very lucrative market, and a lot of people do sell just factor models. They calculate, they build, and they sell the returns and the loadings from these models. So coming up with another set of procedures so that you have a better fundamental factor models is good business. But there are very large fishes in that sea, so you might get eaten. Other factor models. Now, I alluded that when you do the cross-sectional models in step, you end up with the residuals. You might do something with the residuals on top of everything else. And what is it that you usually do? Now, you don't have any more structure to impose. A factor model is a way to impose structure within the returns. You take your stocks, you want to explain them with something parsimonious. And you take your 80 factors, for example, and now you're working with 80 factors rather than 3,000 stocks. It's a bit easier to work with 80 by 80 covariance match, for example, than 3K by 3K. Okay, sorry. I forgot my flow of presentation. Anyway, a slight detour. Under other factor models, there is this thing that usually is done for mutual funds. And a mutual fund is actually, they are starting to be exposed a little bit here in Bulgaria, so maybe some of you invest in mutual funds. A pension fund, or if you go in any of the big banks and say, okay, I want to invest in your funds, they usually have mutual funds for you to invest in. So it's becoming more common in Bulgaria as well, but it's very, very common in the US. Usually retail clients don't go invest on the stock exchange, they go and give their money to a fund, usually a mutual fund, and they invest for them. And when you invest in a mutual fund, you usually get a prospectus, and this prospectus says, okay, my fund will be 70% equity, 30% fixed income, and of those 70% equity, I'm going to invest 50% of that in growth stocks. And the natural question that you must ask yourself is, are they lying? Usually yes. They're lying not so much, but the percentages I said are usually, I'm going to invest between 50 and 70% of the amount in this particular stock, this particular type of market. And then the question becomes, okay, is it 50 or is it 70? I need to know, because I want to diversify my investments and maybe not invest all of my money in your mutual fund, but go across the street and invest my money in the other mutual fund as well, or split them 50-50. And what the academia have come up with is a way to do a constraint factor model where, this is my second equation of the night, third. It's basically a very simple multi-factor regression model, but we kind of assign constraints on that. So we want our coefficients of linear dependence to be positive, and we want them to sum to 1. Now, whenever you see something that sums to 1 and it's positive, you tend to think of a portfolio. This is basically the definition of a portfolio. So the idea of the constraint factor model is, okay, I have the return of this mutual fund I want to invest in, and I have these factors here that are A, investable, and 2, explainable. So I know what this factor is, and I can go out and actually invest in. So it doesn't really work to say, okay, I'm going to invest in this factor that I came up with during my Fama-French procedure. You can't really invest easy in a Fama-French factor. So you need something like a market index, or a particular easy to invest bond index, or something like this, of this sort. And the other thing is that you want your set of factors to also represent all of the possible investments. So you want to exhaust all possible investments in this sense. When you do this calculation, what you end up is a representation of the mutual fund. So you know that if beta is 0.7, they did invest 70% of their portfolio in this particular market index. And you know that they are not lying when they say that they invested 50% within growth stocks. Now, unfortunately, an optimizer now becomes a necessity. When you want to do something with this model, you have to actually optimize it and run it through an optimizer. Now I get back to my previous point, what to do with the residuals of a cross-sectional factor model. And one of the things that you can do is actually run a principal component analysis on that. How many people here don't know principal component analysis from the data side point of view? Okay. There are a few people, so I'm going to very quickly explain what this is. It's basically a dimensionality reduction technique. We want to find some representation of our, let's say, 3000 residuals as a linear combination. This is a factor model, so we want a linear combination that captures most of the variability within those assets. The best asset type or risk factor type or risk driver type that you can actually apply principal component analysis tends to be a yield curve. So a yield curve is, maybe I should have put a plot here, but at certain tenors, let's say 1 year, 2 year, 5 year, what is the return that you expect if you invest in a bond? So you have a zero coupon bond with maturity 1 year, and this zero coupon bond has a price, and this price defines a yield, and this yield then defines an interest rates. Heavy stuff. But within one and the same yield curve, there is a very large dependence usually between the 5-year yield rate and the 10-year. So, for example, if your appetite for yield at the 5-year mark goes up, usually you expect that your 10-year appetite will also go up. So there is a natural dependence between the points of a yield curve. And it's very easy to capture this dependence within a principal component analysis. And usually for a yield curve, 3 is enough. You have 10 or 20 interest rates within a yield curve, but you only need 3, at most 4, to capture 95% of all the variability within a yield curve. So that's all you need to be very confident that you can actually estimate through a simple 4-factor model the changes in the yield curve. It's so prevalent to use 3 that actually people have named the 3 factors for a yield curve. The first factor usually defines a shift. So whatever happens with the first factor, if it goes up by 10%, the whole curve will go up. The second factor is the slope. This controls, okay, is it flat or is it in, for futures markets, this is called contango. But anyway, it's the slope of the curve. And the third one, you can find it as shape, you can find it as butterfly, but basically defines how is it wiggly, to use that very specific academic term, wiggly, how much it changes. Now, when I said that it's a dimensionality reduction technique, I actually lied to you a little bit. Principal component analysis as a definition is not dimensionality reduction. It's a rotation of the space. Where if we want to go to the heavy math stuff, we take the, let's fix 20, the R20 space of where the interest rates live, and we rotate it in such a way so that the first principal component factor actually has the largest variability of all the other. Then we find the second one, which is orthogonal within the probability terms, so it's uncorrelated with the first, that has the largest variability but still being independent of the others. And you do this for all 20 of them. So you're not reducing anything within the PCA. Only after you have done this, you can observe the explained variability or the actual variance of the factors and say, okay, I'm fine with 90% explainability, so I'm going to cut here. I'm going to put the rest in a residual, and that's it. Only after this step, this becomes a dimensionality reduction technique. Not very interesting. Oh, This is nice. Actually, I forgot it's here. For you guys that haven't seen a yield curve, the U.S. Treasury actually compiles and publishes a lot of yield curves, and you can go and see them here on this website. It's basically the U.S. Treasury. An actual dimensionality reduction technique is the latent factor model. I've seen it also called statistical factor analysis, SFA for short. It starts with the idea I want to find 3 factors. This is the first step that you actually do. Say, okay, I want to find my 3, 4, 5 factors. You have to, this is an input, so you have to know beforehand. There are things that you can do to calculate afterwards, but you still have to do, to say, okay, I want to do this with 3 factors. And what we lose when doing this is actually that our factors are no longer very easy to interpret. It's not a shape, it's not a shift. The reason for the lack of interpretability is that if we actually rotate the space, we can change almost everything about the model, besides the residual. The residual is fixed, the rest of the things are there. I'm actually not aware of time, and that's a very difficult to do. Okay, 5 minutes is fine. Okay, I can do 5 minutes. And actually, if you apply the statistical factor analysis to a yield curve, you get a split of the yield curve in terms of buckets of terms. So the first factor, for example, will capture the shortest part of the yield curve, where the variability is largest. Usually the 1 month, 2 months move a lot, so there is a lot of standard deviation there. And the second will take the midterm, and the last one will take the long-term part of the yield curve. And I said I have 5 minutes. I can manage 5 minutes, even though I talk a lot. What I wanted to have a slide on is actually two models that I really like. And the reason they're on this slide is they have a factor model built into them. They are not factor models, but they end up using tools from the factor analysis and the linear regression components. One of them is a Black-Litterman model, which is used for combining investors' expectations. So the idea is very simple. Hopefully I can explain it simply. You take the market, and the market defines what the market expects to do. So in a perfect market, the market prices, say, are a combination of bulls and bears, and they net each other out, and you end up with a price which basically says this is the market and this is the expectation of all the stocks. Either they go up, they go down, doesn't matter. This is the equilibrium idea of all the market participants. They came together in the exchange and they come up with this price. They discovered this price, and this is the equilibrium price. And this is all fine, but you as an investor would like to make money, and you thought of something else, and you have another idea. It's not that these prices will remain, but you have an idea that they'll go up, and they'll go up by a certain percentage. And these are your views, and you want to combine your views with the views on the market. And the Black-Litterman model is basically a way to do this quantitatively. Let's use this word. And it ends up being a factor model ultimately. The other model that I really like, I'm gonna call it Steinbauer's model. I don't think it really has a well-established name, but the paper that I'm citing is basically analyzing investments whose histories differ in length. And let me ask you a question. How many times have you seen a data set where the first three factors have 100 observation, the next three factors have 70 observation, and the last three have 50. Many times. This model aims to calculate a consistent covariance matrix and estimation and estimate for the expected return using all the available data. So you're not just cutting at 50 and saying, okay, I just don't know what to do with the other data, so I'm cutting the first three in half, and the other three I'm losing 20 observation each. This model aims to calculate this in a consistent way. And the consistent way actually turns out that you regress the short on the long and use the estimates of that regression to form your covariance matrix estimates and expected return estimates. So these were the two models that I wanted to share with you as a way to basically express to you that factor models and the regression are not really just used for regression modeling. You can find them in other places, and if you know your regression modeling, you can actually see other things and use them and define other interesting ideas. I think I have 3 minutes, so I'm gonna very quickly just show you what I have on these slides, and we can discuss this afterwards. Some idea about the different fitting methodologies that are applied in finance. So the usual is maximum likelihood, where your innovation are Gaussian or a student or something else. You have your OLS, and maybe you know that these two are different but lead to the same result, but maybe you don't, so I have that on the slide. And weighted least squares is very interesting because it aims to deal with the fact that in time the variability changes, so you can use something consistent there. But there are all kinds of other methods for actually finding estimates that are used throughout the industry. L1 is basically where you optimize not the sum of squares, but the sum of absolute values. And I'm sure that you've seen it in mean absolute deviation. It's the same idea applied to a factor model. Lasso, very famous nowadays, but basically it's again a constraint optimization for the mean square. You probably have seen it in its Lagrangian form, where the constraint actually is put inside the optimization function. Rich regression, where the constraint is not on the L1 norm of betas but on L2 norm, and of course elastic net is a combination of lasso and rich on itself. You can do robust modeling, where there are books and books written on the subject. L1 is actually a robust technique, so it reduces the effect of outliers. Very alternatively, you can actually put heavy tailed. I kind of mentioned it in MLE modeling, where you say your innovations are T, or you can go beyond that with even heavier tails. And actually, the funny thing is that it's usually easier to do Bayesian modeling when you change the innovations. Not always, but usually. And thank you.
Okay, thank you, Metodi. We have several questions over Slido, so we're going to go there. First one is relatively probably quicker to answer. How do you come up with the number 3000 when you get an example? Yeah. When you give the example, is it the Russell 3000 index?
Usually. Just in case. You usually start with 3000. This is the index that forms the market, let's say, but you kind of cut off because you don't have fundamental data on each and every equity out of that 3000. So Yeah.
Okay, good. You can read the next one.
Can you? Ooh.
Can you elaborate on
Sorry.
the difference between the risk and alpha models?
Okay. So a risk model is when you want to estimate the risk of your portfolio. So you're interested in how much money you're gonna lose or you are expected to lose. What is your downside, and you do this for risk modeling purposes. An alpha model, you do it because you want to optimize your portfolio. You want to find such a weight vector that brings you to much expected return and bonuses at the end of the year. That's the fundamental difference between those two. They are applied for different things, and for alpha model, the actual thing is that you don't really need to know the expected return. You want to know how different stock are in relations to the other stocks in your portfolio. You want to find your winners, those that are gonna appreciate in values, and your losers, those that are gonna depreciate in value, so you can short the losers and be long the winners.
Okay, next one. Define innovation in
Ooh.
connection with your favorites, the last slide. Is the
Innovations. Okay. Do you recall the kappa M model? It has an alpha, beta times the return of the market plus 1 epsilon. And that epsilon is actually the innovation. It's I'm not sure why you're laughing. I'm laughing because you're laughing. So yeah, innovation. To be honest, it's not really the correct word to use within a factor model. Residuals, idiosyncratic risk are better. Innovation is also epsilon when Arma-Gauch modeling comes into play, something that we don't really cover here, where this is the random noise that gets added to the Arma-Gauch models.
all right. I was laughing because there is a question here below the last one that actually
What should be the
accounts for your how is this, for your expertise.
Ooh.
They ask how's your life, how's life.
How's life? It's probably very nice so far. Thank you. Very, very fine this evening. Yeah, we have
Okay, we have one
two.
very specific one. The other tools are more general, which we can skip, but we're please answer this one.
Does the Schramm-Baum method work for more volatile markets?